Hi, and welcome back again to Tim Bigham's Options and Volatility Newsletter. We'll be taking a look today at our two-day trade, a nice vol capture trade that reverted quickly on Rocket Labs, able to take the trade off in a couple trading days for nice gains. So let's jump in and take a look at just how fast and furious that reversion took. Here is the chart from 8/16 Friday, the day of the trade idea, right? You can see Rocket Labs, as we noted in our previous video, getting way overbought technically, but did soften here. This key reversal may say the huge rally's over. More importantly, IV off the charts here, right? You can see this huge spike. This is post earnings too, so not earnings related. So this is what we look to take advantage of to sell very inflated IV. And then you can see on Tuesday, right, IV absolutely reverts, not to back exactly where it was, but certainly, we'll see in a second, a big enough reversion to make some nice gains. Stock did soften, tried to break out once again, failed. All the technical softening as well. So here was the original trade on Friday, that massive call spike, right, where IV explodes across the spectrum from basically around the 60 level to over 130. We can take a look at the reversion, right, where IV, which got to over 130 way up here, did revert back sharply towards 110. That's across the call spectrum. Taking a look at both calls and puts, same idea here. We talked about in the previous video. IV basically just chopping around, then boom, because of big volume, a incredible vol spike. We elected to jump in, sell the spike, right? And then 2 days later on Tuesday, we'll see in a second, that IV absolutely reverts back, right? The puts, which were trading over 120, back to nearly 100. The calls over 150 at 125-ish or so as far as the 90-day options. We can take a look too across both puts and calls across the term structure of vol spectrum on a shorter basis, 3-month, well behaved, as we keep saying, right around that mid 60 level. Volume comes in, pop. Once the volume dries up, drop. So we did sell the pop and buy the drop and make a very nice profit, doing it all in a judicious fashion as well. So again, here it is just on a single option, a little clearer to look at. This is the 30 delta, slightly out of the money, 90-day call. Again, very well behaved. Volume comes in, sell the rip, cover on the dip, and that's exactly what we did here. Here's that incredible volume from Friday, right? Over 260,000 calls, over 30,000 puts. IV, as we noted, at 100%, the most expensive of the year. Sizzle index over 3, which is rare indeed. Then on Tuesday, the day we cover the trade, everything softens, right? IV drops from 100 to 74, still not dirt cheap, but certainly nowhere near the levels they were before. Call volume tempered dramatically by over 200,000 calls, right? 269 to under 65. Puts cut more than in half on the volume. Sizzle index now at the mid 0.55-ish level. So certainly that has calmed down a lot too. So let's take a look at how our trades did. Here was that Jan 6 buy rate from July 15th when vol was pretty much normal, that mid 60 level we kept referring to, right? You can see the buy right around 475, right? Stock at 572. Fast forward to the day of the big volume, August 16th. You can see that the buy rate actually got cheaper, went to 460, right? Even though the stock went up 84 cents from July 15th, or almost 15%, the January 6th call actually went up more than the stock, making the buy rate cheaper. That's set up ideally for a covered call trade. Buy the stock, sell that very expensive call, trading at well over 100 IV. Then we go to the reversion day, Tuesday the 20th. The stock did move up 9 cents from Friday, right? However, the January 6th call actually dropped in price, right? Because IV, which was well over 100, dropped to the mid 80 level. That buy right picked up 13 cents, even with the stock only up 9 cents, because the calls made money as well. The calls actually dropped in price because of that drop in IV. Then taking a look at the October 6/10 sell strangle, selling the $6 put, the $10 call, right? Here it is on our kind of baseline on July 15th, stock at 572. The 6 put trading at 85 cents, in the money, right, by 28 cents. 10 call virtually worthless, trading at under a dime. Again, the IV at that mid 65 level. selling the strangle a little over 90 cents. You would have been net long 40 deltas. Fast forward to Friday, the day of the big spike in volume and IV, right? The stock 656 up, right? Which means that this sell strangle should have come down in price from a profit because it was net long to begin with. Nope. Because the $6 put actually gained 10 cents, even with the stock moving 84 cents higher, right? And time passing, a month passing. The Oct10 call went up 60 cents, almost as much as the stock, right? Why? Huge jump in implied volatility, 58 vol point jump on the put, 75 on the call. That 610 sell strangle, $1.62.5. Even though both sides are now out of the money, right? Stock at 656. Before, remember, the $6 put was in the money. Ideally, with a sell strangle, you want both sides to be out of the money. And if you would put the trade on, about as flat as can be, net short 1 delta. Fast forward, let's go to Tuesday, the day of the reversion, right? Stock did move up about 9 cents, right? That $6 put, though, dropped a quarter, right? Simply because of that IV reverting. That $10 call dropped 17.5 cents, right? Because, again, the stock went up, right? But the call came down. Why? Because IV reverted. 18-point vol dump on the put, same on the call, right? That Ox 610 strangle, which was over $1.60, $1.20 on Tuesday's close. Net gain of just over 40 cents, or about 25%, right, in 2 days. So a very nice trade on a neutral trade. Remember, we were 1 delta net short, and the stock went nowhere. So truly money for nothing. Taking a look at our Ox 7 sell straddle, right? Here's the baseline day, right? That straddle at $1.87. Won't go through it. It's in the first video. And then the day of the big volume and big spike, that straddle went all the way to $282.50. Even though it got closer to $7, right? It should narrow that, right? The straddle should become cheaper, but this huge jump in IV again expanded that, setting up ideally for a sell straddle, right? And you've been short 11 delta, certainly not massively short, and expectationally pretty much delta neutral because you expect a move up in the stock price to eventually temper IV. Then we go forward to the day of the reversion. The stock did go up 9 cents, right? That sell straddle dropped to 232. Why? Vol dropped 20 vol points roughly on both the calls and the puts. So even with the stock virtually unchanged, crept up a little bit, right? Able to take 50 cents, right, in 2 days out of that trade, or 17.5%, right? So selling it at 282.50, covering at 232.50. With the stock going nowhere over just 2 days, the IV reversion is what it was all about anyway. So taking a look at a summary, we can see July 15th, here's our base. Then on the day of the big volume, big IV spike, you can see IV just exploded from 66 roughly to almost 140, right? The straddle 282.50, the strangle 162.50. Both of these should have cheapened from a price perspective because the stock went above 6 and closer to 7, which should cheapen the straddles and strangles, but instead, because of this massive vol spike, they got more expensive, which set up ideally to sell these, both in a very judicious, somewhat delta neutral fashion. Then Tuesday, we saw all that kind of start to revert back. That 610 strangle dropping to $1.20. The straddle to 232 and change, right? IV tempering by over 20 vol points, as we can see here. So able to pick up 40 cents or so on the sell strangle in 2 days, 50 cents on that sell straddle. And here's kind of the sell the pop, buy the drop, sell the rip, buy the dip, right? Sell the pump, buy the dump. And that's what we look to do day in and day out. Identify relative pricing inefficiencies, big edges where we can put on trades that are fairly delta neutral at trade inception, just looking to capture that volatility and the ultimate reversion. So hopefully helps explain the strategy and what we look to do day in and day out. And so until next time, as always, here's to good trading. Take care.